In this video you're about to watch is an excerpt from our past webinar that we host every Thursday in the evening. Now, this was the first of many, and this will be a one-of-one. We won't be posting this on our YouTube channel, so we need you to follow our social media platforms and also follow when we update when the next webinar is, because those are exclusively for those people who can take the extra time to join us on the social media platform and join us on the webinar as well. But this is a live example I want you guys to go through and understand, and it was one of the best sessions that I ever had. We had about 70 people who joined and they stayed till the end, and it was a good 1 hour 30 minutes, but in this video we've shortened it for you guys to get an introduction of what I talked about. It's not the full video. And we talked about the technical analysis, and I told people in this one, let's get deep. Let's get deep into technicals. Let's analyze the technical analysis, what to look at, those key levels, those the difference between market structure and price action, understanding fake outs when market manipulation is in the market, when stop losses are hunted. I talked deeply about all those in this webinar. So enjoy this, and I'll see you in the end. So karibuni, welcome everyone. My name is Caleb. For those who do not know me, thank you for joining. At this time, I won't take much of your time. Just a 1 hour session from 7. I'll be done by 8. We get deeper into the market analysis in different ways. Markets are unique. Everyone is unique. So we need to approach the markets depending with our own unique style. So today I'll be talking about deeper stuff, not the basics, not how to draw a trend line, how to analyze the market. Those ones we've done them multiple in our YouTube videos. You can go check them out. So today I'll talk about a couple of stuff. So if we just start diving in a little bit, what if you could read the market's hidden language? Most traders see price, smart traders see intention. So I'll talk about that. It's all about psychology. Today we'll uncover the truth behind smart money and price action. So don't get me wrong, it's not smart money concepts. I don't trade that. I trade market structure and all that, but not exactly smart money concept, but it's more or less similar, okay? And by the end of this class, you'll never look at charts the same way. And that's my goal for today. I want to give you an introduction to how to look at the markets, how to think about the markets, how to analyze the markets on a general way, and then hopefully you can do it on your own. So this is what I want us to talk about today. What will you learn today in the next 45 minutes? The invisible hand of the market, smart money and liquidity, price action at a deeper level, the truth about market structure, then the hidden science of chart patterns, why they work and why they fail. So before I go far, something that I want to show you, in trading, you have to read a lot. You have to understand the markets. I was teaching a class earlier on today, and we were talking a lot about reading extra than actually what you normally get at any time in the markets. So many people come to the markets and they want to understand it in a technical way. So they just want to come, this is my charts, and they want to analyze this market. They just want to look at the market. Is the market going up? Is the market going down? Can I buy? Can I sell? Only that. Now, if you want to become a successful trader in the long term, I think there's more to that than just looking at whether the market is going up or down. You need to understand what is actually happening in the markets, okay? So we're going to uncover that today. I'll give you a general view of how to look at the markets and how to break it down as well. But as much as I'm saying you need to read, one book space that stands out for me above all books when it comes to technical analysis is this book, okay? So this book is let me show you. This is, let's go to the home page. Okay, The Art and Science of Technical Analysis. I've always shared about this book. I've always talked about this book multiple times. Okay, The Art and Science of Technical Analysis. This is one of the best Forex technical books I've ever read. And he doesn't just cover technical stuff. It's written by Adam Grimes, but it covers a lot. You can see here part 1 talks about the foundation of technical analysis. He's given data, history, and how different traders trade, including him. Then part 2 is about market structure. So he's done different stuff on trends, ranges, trends and ranges, the connections between them. Then part 3 is going deeper, talk about trading strategies. Okay, different trading strategies that different people look at. And then he's coming and talking about the individual self, the self-directed trader, how different traders think, okay? How to become a trader. So they're divided into those 4 parts. Now, for me, I want you guys, if you can, get this book, you can go online, purchase it anywhere, and understand the foundation of technical analysis. In this case, for example, I was going to show you, if you come here to chapter 1, basically, I've read this book multiple times. Every time I read it over and over again, it's talking about I get to see something different that I hadn't seen before, okay? So if it's one specific book that you'd want to read, go read this book on technical analysis. It's very broad, so have an open mind. Then get nuggets here and there of how you can implement it in your own trading strategies. Cool. Now, one thing I also wanted to talk about is making money in the Forex market is not easy. How do bankers trade? Okay, that's another thing that I want us to look at. The big people are the market. They're the ones who push the market. So you can come here and read all this. This is a link I can share with you guys later on. It was written sometime back in 2022, but I've always bookmarked it. It always stands out for me, okay? The bank traders take only 5% of the total number of Forex traders, with speculators accounting for 95%. So the banks are only 5% of the market, but they are the market, okay? So how do bankers trade? They actually perform 2 to 3 trades in a week, okay, of their own trading accounts. They trade very, very few. They do not clutter their markets with many stuff. I see a lot of people cluttering the markets with Fibonacci, RSI, stochastics, MACD. You've thrown all those things on the market just for you to get an edge. That's not how you get an edge in the Forex market. You have to, at the end of the day, even here this writer has said, it all comes down to simple support and resistance. No clutter, nothing to alter trading decisions. It is simple and straight to the point. So this is a whole article. I can share this later on. You guys can go through it. But for today, let's get straight into what I want us to talk about. And the first thing I'll start with is price action. Why market structure is more than higher high, higher low. Okay? So I want to show you the difference between price action and market structure. I've always talked about this. If you watch my videos on YouTube, you'll always see I've talked about this before. A real breakout versus a fake out. Okay? How to tell the difference. Market structure is a story, not a formula. So it's not a fixed formula where if you see something happening, this is what should happen. It's not 1 + 1 = 2. Okay, today it can be 1 + 1 = something else. Tomorrow 2 + 2 = something else. It's never a formula. It's a story. And you need to understand how to read that story. And the best way first is to understand price action and market structure at a different level. So now, price action, okay, now if you have somewhere you're writing this down, I hope you are, okay. Price action, the difference between price action and market structure, that's what I want to explain. Price action, let me type it here. Well, let's use a table. Let's use this table. I just need to, okay, so let's say we have price action, okay, and we have market structure here. So there are 2 distinct differences between the 2, okay? Structure. So price action is dynamic, okay? And in the past, in the present, okay? Market structure is static, okay? Sorry. Market structure is static and in the past. Okay, so it's important for you to understand this too. Price action is dynamic and present. Market structure is static and in the past. Okay, so what you're seeing happening here, what is most recently happening, is price action. A lot of people try to trade price action, and trading price action on its own is more or less gambling. So how does price action look? What you're seeing here, as market is moving up and down, prices are fluctuating up and down, okay? So market goes up. Let's go to a gold chart. Many people are familiar with a gold chart, for example, okay? That was a US 30. Most of you are not familiar with that market. So price action is this, what is currently happening. Market is moving to the upside. This is the 4-hour chart. That is price action. You can see the price here fluctuating. So as the market fluctuates in price and goes up and down, that is price action. So it is present and dynamic. By dynamic, it is always moving. Now, market structure is anything that has already passed from this red candlestick you're seeing here, moving backwards. That is all market structure. It is in the past and it is static. It will never change. It has been imprinted in history. That will never change, okay? This red candlestick you're seeing here will forever remain like that. If I go back, what date was this? If you look down there, that's 27th January 2025 at 5 p.m. That will never change. It is time-stamped, it is static, it is in the past, okay? Price action is present and dynamic. Market structure is in the past and it is static. It will never change. So we use market structure, to try and read the market, try and understand, okay, what pattern is the market forming? What pattern did the market used to form and what used to happen after? What repetitive patterns are forming? What candlesticks usually form at the bottom of a trend? What candlesticks form at the top? What market structure, what patterns? Those things are what we call market structure. So we use a lot of market structure to read and analyze the market in the past, just to understand how the Forex market works. Those higher highs, higher lows, higher highs, that structure, that market structure is normally in the past and it is static. Now, when you're trading in the Forex market, you need to know how to combine these two. The market structures that are forming as market continues and the current price action. Price action is a real-time representation of what traders are doing at mass scale, okay? I'll repeat that. Price action is real-time data of what traders are doing at mass scale, okay? So when you see the market moving up, the bullish candlestick forming, it means that during that present time, a lot of people are bidding prices higher. Many people are buying and buying into that market, and vice versa. If you see the markets are red, okay, during that specific time, people are selling and selling that market. So you need to understand what candlesticks do I need to understand to know when a certain structure forms, I need to buy and sell. Now here at Financial Hub, we use a combination of the two. We use both market structure and we use price action. I will show you a few things that form in terms of repetitive nature. So for example, and I shared an article like this just not long ago, but on Financial Hub's website, okay? This is gold chart. Gold chart has come from 25.86 or 85 around there with a very good bullish trend. Now, if you look at this trend, something has been very repetitive. Okay, so if I put an arrow down here, you can see. So let's just mark the higher highs, higher lows. Anytime I'm analyzing the market, I first want to discover what is the bias, what is the direction market is moving. So you're seeing this higher high, okay, higher high, higher low, okay, higher high, higher low, higher high, we got a higher low here, higher high, higher low, higher high, higher low here, we got a higher high, we got a higher low, okay, higher high, higher low, we got that higher high, we got this higher low, sort of like a double bottom, so around here, and now markets are pushing a little bit to a new high, okay? Now, that's step one, so it's just simple, higher highs, higher lows. Now, the next thing I want to look at, what repetitive pattern is here? So here, there's been a very basic repetitive pattern where market creates a new high, retests the previous high. So if you understand support and resistance, when market is moving in an uptrend, it is successfully breaking resistance levels. So it is moving higher, higher, higher. Okay. Now, when a resistance is broken, what happens? It becomes support. Okay. Now, this market has created a very good successful formations of breaking a resistance, coming back to the support, breaking resistance, coming back to support. So if you look here, so there's sort of a resistance here, more or less. Okay, somewhere there, like an average level where market created that high support. Okay, created that high. Now, this previous resistance here, you can see that became support. Okay, markets created a new high, that became support. You're seeing that? Higher high, higher low. Okay, broke a new high. We did not get a perfect support here. Just as usual, markets are never perfect, okay? But sort of markets came close to that level. But then again, created a new high. We got a support here again, okay? One sec. Okay? Okay, so higher high. Over here, we did not get a perfect one, but market came close to around that level. You're seeing here, market created a new high, support became that level. So at the end of the day, you want to look at the market. What's the market doing in a repetitive way? In this case, I'm not saying market will always do this. So this is not like a strategy I'm telling you to trade. But once you spot that, and markets like gold and indices normally really trend in the direction of a trend for a long time, when you get such repetitive patterns, it's better for you to look to buy in that direction. So those are some market structures you need to be looking at. The number one basic one is to find the bias of the trend. Which trend is the market moving? Which direction is market moving? There's a podcast we've done with a few friends here and there. I won't mention, but it is coming soon because I want you to anticipate that. We talked a lot about everyone was in line and everyone talked about we are always looking for the direction of the trend. If you trade and you don't know what direction you're looking for, then you've started off in a wrong way. I'll look at the dollar index right now, slightly, okay? Because the dollar index is something we're starting to see and we were discussing in the podcast as well, that we believe in the next couple of months will be in a downtrend, okay? But many people might ask, Caleb, how do you know we're in a downtrend while market is still at the top? Now, I'll use market structure and price action to show you that as an example. Now, if you see here, market was forming good higher highs, higher lows. I'm always marking them, okay? Now, using the Dow theory. So, now look at this downtrend. Market was forming lower low, lower high, lower low, lower high, lower low. Then what happened after that? Market broke structure here. Okay, I normally call this here break of structure. So now this is more or less BOS. I call it that. I've seen a lot of people depending on where you learn how to trade. Many people call this as well break of character or change of character from a downtrend to an uptrend. Me personally, I don't use that language, but it's the same thing. This is for me the break of structure. What does a break of structure mean? Change of direction. Okay, now you can see this break of structure. Market started doing what? Getting successful higher high, higher low, higher high, higher low, higher high, higher low, okay? Then what happened here on the dollar index? Markets tried to come back to the previous high and go higher, but market failed. That's signal number one. Signal number two is that markets then came down and broke structure, okay? So here, let me just mark this as, I won't write all of it, but let's just write it as BOS. Now, for me, this is significant information that this is a break of structure. And what did we get after that? Breakout, retest, market is going. So this is a third confirmation. So first, failed to create a new high. Second, break of structure. Third, it's retesting and market is falling down with momentum. Okay, not all the time market will do that retest. You can see here, market broke out and we got what I usually call a successful follow through. Market didn't even go back to that trading price. Markets just went, okay? And another signal that affirms that market is changing direction or moving in that direction is that we get a strong breakout. Always wait for candlestick to close. If you're trading technicals, and I always tell my students this, you cannot trade technicals halfway. You have to use candlestick closure. That is a must. You should not even think about it. I've done this, and you guys can try it out. I've done this many times. I've tried trading where I'm anticipating a candlestick to close. So I start anticipating and saying, I think this will be a bullish candlestick. I think this will, so let me enter early, okay? For example, like this one, look at this this candlestick here. What this basically means is that during that day, the buyers tried to take this market up, 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 up. So if you just started buying because you feel this is a strong candlestick to the upside, my friend, you're very wrong, because what happened during that day? Markets came down, closed at a bearish signal, okay, bearish candlestick. And what happened after that? Market has been a downtrend. So if you're a technical analyst, you have to be patient with regards to the time frame you're trading, to always wait for candlestick to close. For me, this is a 4-hour chart. I mean, this is a daily chart. When I'm looking at the direction, for me, my bias is always on the daily chart. And then I go to the 4-hour to look for patterns. So you think that successful, strong close of a bullish candlestick to the upside, okay, that is what affirms that the market has broken and going up. Look at the opposite. This is a strong candlestick. It has affirmed that market has broken structure and moving to the downside. So number one, that is how I establish a trend on the daily chart, using the simple formation of higher highs, higher lows, reading the candlesticks, because you need to read the candlesticks. A candlestick, if you get deeper, a candlestick is basically a representation of what buyers and sellers are doing, okay? It is not, yes, people will come and term it differently. This is a marubozu, this is a shooting star, this is a... I know of a trader who doesn't know the names of those candlesticks, but understands what a candlestick means. That guy is much better than anyone who's trying to call this is a marubozu, this is a shooting star, okay? Because he understands different candlesticks and knows how to put it into perspective. So that's how you look at candlesticks. That's how you want to break down the markets. Step number one, using structure. So markets are not all about, and that's what I was saying here. Markets are not, they're more than higher highs, higher lows, okay? You need to understand that difference between price action and market structure, okay? A real breakout versus a fake out. And I've talked about this a lot. What is the difference between a real breakout and a fake out? I normally call these two a successful follow-through or a failed follow-through. And actually fake breakouts normally tend to give very good trade setups. For example, here, if you come here on a 4-hour chart, let me show you. Now look, for example, here, this is US 30. Allow me to use different markets for different examples to mean the same thing. So it's not that it just happens in this market. Now look at this. This was a perfect entry signal to continue buying. So if you zoom out on this market on a daily chart, bigger perspective, okay, look at this. Market is in a bullish trend, okay? So we can clearly see that. We can all come into agreement and say the US 30 of this market is in a bullish trend, okay? So I want to show you two things. I want to show you how market had a failed breakout, tapped liquidity, and then continued with the direction of the trend. So I'm normally looking at the daily chart for direction. So then I come to the 4-hour, okay, here. I come to the 4-hour to look at, okay, what is actually happening. So here, you see here, now for me, I normally look for such support. So you can see if I zoom it out, market was on a big picture. This was a higher high, so this was a higher low, okay? Higher high around here. So markets came back down just to get some sideways movement here and getting some support, okay? So you can see the support here. And then what happened, you find that many people already start putting long positions after maybe a confirmation, a long candlestick here. They're anticipating this market maybe to go higher, and they put their stop loss just below this level. Market went up, came down, they took another entry here. Maybe if you didn't get your first entry, you came and decided to take it here. Then what happens? You get this stop loss hunt, okay? And someone was just asking in the group, I can see Derek Langatio asking, understanding liquidity sweeps and grabs. Also, James was asking how to avoid stop loss hunts. Now look at this. Markets came lower just to spike you out, then eventually continued going up. So at the end of the day, you sit down and ask yourself, why is the market always taking me out, then going? You start victimizing yourself, saying, this market is watching me. This market knows where my stop loss is. And then I normally find people concluding never to use a stop loss. So they start saying, I'll never use a stop loss because they're always taking my stop loss out. So many people start saying, my stop loss is the problem. It is not your problem. You're placing stop losses at the wrong place. Now look what actually happened. If you zoom out, okay, there's this here. Now this is a liquidity level, okay? How do you get to know a liquidity level, okay? Liquidity levels, if you look at the market, or rather how I look at liquidity, because if you go online, everyone has their own version of how they look for liquidity. For me, I look for liquidity where market previously had a lot of activity at that point. You can see here, this is a liquidity level for me because at this level is the level market held and pushed to a new high. Okay, you can see that momentum. this momentum that followed after market came to this level. So there's a significant reason market stopped here and strongly pushed high. So I believe if market comes back here, there's a high chance, not a guarantee. Trading is all about probabilities and chances. There's a high probability that the same might happen. So when markets came here for the first time, this is a level that's just floating. To me, it's not significant enough, okay? And market could come here and continue going up and I don't get an entry. But for me, I'm trying to look at, okay, read the market. I'm not just trying to trade. I'm trying to understand and get a good feel of what is happening in the market. So what happened, if you're patient enough now, let me explain what happened here. Markets consolidated quite a bit, and then spiked to the downside. Now there's a trap here that can happen. Many people can start selling, which is not a good thing because we've seen the overall trend is to the upside. Okay, so I want to be looking for net longs. I want to be buying, okay? So immediately markets came down here and tapped this level. The first thing, I won't also buy. I won't just come and buy here because it's just gone below, okay? Market has also broken below quite a significant support. Okay, so I don't just buy immediately. Okay, what do I want to do? I want to see how market is reacting. Now you're reading price action. What are the traders doing? Always look at candlesticks as if it's people doing some action. You want to see what are the people telling me? What is market telling me? Don't rush into entries, okay? So what happened immediately? Markets closed below. It came down here, played around here, did not close below that level. What happened immediately? Came back above here. Okay, so this was a fake out, a stop loss hunt, liquidity grab. Okay, and immediately it came back and closed above. Now this is your signal to go long at this level. Okay, once market has confirmed, then you can put a good stop loss now below the liquidity zone here. Okay, not inside here, because markets can play around this level and spike you out before it goes back up. So put below that level, okay, that's liquidity level, below that support level. For me, I always like taking my targets at the previous high. So you find that I'll come and put roughly around this point, okay, which is giving me a good risk reward of 1:4 on that trade. But if market goes back up, goes back to the previous high, I make a cool 4.4 or 4 or above 4% return on that one. Now that takes time and that takes skill. There's a similar thing I'm also waiting right now here. So come here. So here, there's a similar thing I'm waiting for yet again, but at a smaller scale. It's not as big as this one, okay? So I'm trying to see what will markets do around this level. That's what I'm currently watching and currently waiting. There's a lot of liquidity here. You can see markets up, down. So I'm waiting to see and confirmation. I have my confirmation comes from candlesticks. One thing I can tell you out of today's lesson, never take a trade before a candlestick closes. It is simple, but people lack patience. I've seen, and some of you, I'm sure, are victims of that. You've lost a lot of money because of not paying attention to candlestick closes. There's someone asking me, Caleb, why don't you use the 15-minute time frame? Which is a good question. If you see here, I'm very stuck on the 4-hour. Each candlestick on the 4-hour chart closes after 4 hours. So you might be asking me, Caleb, why don't you go to the 1 hour? Which I do not. Okay, I used to, but I do not anymore. Why don't you go to a 15-minute time frame? Which I do not. Okay, now if you come to a 15-minute time frame, okay, this market looks like it is significantly in a downtrend. You can see these markets are moving strongly to the downside. Okay, but if you come to the daily chart, okay, this market is significantly moving to the upside. So you get a bit confused. So your biases start becoming, okay, 15 minutes, I want to sell. But on the daily chart, it's telling me to buy. So for me, I try and think how bankers are thinking and how the money makers are thinking, okay? I strongly believe that there's no bank that wants to put $100 million on any market because they saw a bullish signal on a 15-minute chart. The reason retailers look at 15 minutes and lower time frames, and I'm not saying they do not work. So don't get me wrong. I'm not saying they do not work, but my own thinking of how the markets work The big bankers pay attention to significant time frames on the higher time frame because they're making significant long-term trades. Okay, they're not taking a trade today morning worth 100 million, then in the evening they're trying to liquidate it. They're not taking a trade worth $1 billion, then tomorrow they're trying to liquidate it. No, there's no quick liquidity to get such entries in order to come out that quickly. So, because if they do such, they can crash a market, which can make them lose a lot of money. I'll explain that later on. So for me, I believe that a lot of bankers and trades and market makers pay attention to a daily chart. And if they're doing swing trading, 4 hours is a significant time frame to look at. When I go to the 15 minutes, I find a lot of breakouts. Markets break into the upside, like you can see here, markets is sort of pushing to the upside, then it's coming to the downside. All of a sudden it comes down, then starts going up. So for me, I find it it does not hold significant information. If you saw here, the market structure is a story. The lower time frames, stories are sort of like a hoax. It's not the true story. I can't come and say this is a 15-minute candlestick pin bar. Let me buy this for the next and hold this trade for the next 2 days. Oh, no. I don't believe there's that significant. You can come and do that and be lucky, but I don't believe that's a long-term strategy that actually works. So for me, the lowest time frame I pay attention to is the 4 hour. I use the 4 hour for analysis, for getting my patterns, and I use the 4 hour for getting my entries. Long time, if you found my analysis last year, you'd find that I always used to say, I also come to the 1 hour for entries. But trust me, I've tried trading the 1 hour for entries for a long time, and they do not, for me, okay, they haven't worked significantly. You get an entry like this one here, market's telling you buy, just for it to go up a little bit, then goes down. Okay, you get a candlestick like this one, goes up a little bit, then goes down. Okay, so you start asking yourself, okay, this textbook candles, what I thought actually worked, why are they not working? It's because I don't believe a 1 hour candlestick holds significance to push markets in a certain direction for the long term. So I'll continue answering your questions, but let me continue with my slides. The next slide, invisible hand, why most traders lose the liquidity trap. Market hand stop loss. Actually, I've just shared with you this one. I think I had it in my mind, so I've shared with you that market hand stop loss. It's not random, okay? So that's what I'm trying to see here. For example, this is US30. I'm trying to understand, when market comes here, I won't just buy immediately when it touches here. I want to read price action during this level. So I hope you enjoyed that video, and more of this. That is not all of it. We stored the rest for the people who join the webinar and for our students who take up our course. But I hope you enjoyed that. That is just a sneak peek for you guys to understand the value pack that we're giving people in those webinars. Join us every weekday on Thursday in the evening and be part of the community that is constantly improving every single day. Like we say with Ken here, 1% improvement every single day will get you much further at the end of the year. You yourself will be surprised with how much improvement you will have in yourself, okay? So join us in the next one, and I hope you enjoy that. And like I always say, stay woke, stay financially literate. May the peeps be with you. See you soon.